if you go into a coin shop and try and buy some gold today, they'll be quoting you a much higher price over the gold price than they usually do. And if you try to sell it, they'll be quoting you a much lower price than the usual gold price than they usually do, because the gold dealers literally do not know where the price is going to be tomorrow. It might be up 5%, it might be up 10%, it might be down 10%. I think what's going on with the gold market now is up until a couple of years ago, people kind of saw gold as a steady as you go an inflation hedge asset. That's how it was viewed. But that attitude is changing now, because people can see that things are going potentially wrong with the levels of government debt and geopolitics. And they're starting to say, I don't know what's coming, but I think I don't really care about inflation anymore. I'm not looking at inflation in gold. I think I'll get some gold now, because I don't know what's coming. You should never be planning to sell. You should be planning to keep it forever, pass it down the generations, just like a painting or a work of art or the family castle. Those are the things. The gold physical is what you don't sell, you hang on to forever. When you decide to buy a stock, you think about how much you want to own at the end of the day, divide it by 3, and you invest 33% of that end amount in the equity. Then you wait.
In this conversation with Clive Thompson, we discuss why the gold and silver markets feel so broken right now and what that means for anyone trying to buy. We'll talk about how the US Treasury has a mechanism to revalue gold to $15,000 and use it to wipe out the national debt without most people even understanding whatever happened. And we'll go over the simple 33% investment rule that Clive has used his entire career to make sure he is never the last fool, no matter what the market does. This is part 1 of the highlights from our conversation with Clive Thompson on our live show, Memes and Markets. Let's dive in.
Welcome, welcome, welcome. In honor of our guest today, I will say hello, dear friends. Keith, how are you today?
Today's the best day of my life, Ben. How you doing?
Me too. We have an awesome guest here who I've watched so many of his videos, so I'm so excited to pick his brain in person. So Keith, I'll let you introduce our awesome guest.
Yeah, well, we have Clive Thompson with us. Clive, I was checking some of the data in my YouTube, and I was looking at who my audience watches, and you're always one of the top people in there. So it's awesome to have you here. I think a lot of people are going to be excited for this conversation, but if you will, tell people just a brief intro to your background.
Sure. So I worked in wealth management for 47 years, in Switzerland mostly, retired 3 years ago. Never ever planned to be on YouTube. It wasn't even a remote dream. So that kind of happened by accident. And yeah, here I am on YouTube talking about investments, gold, silver, Bitcoin, property, anything you like.
So cool. So cool. What was it that made you decide to get on YouTube?
I wrote an art. I was a regular writer on LinkedIn. I mean, the funny thing was, when I was working, I was never on LinkedIn. LinkedIn is obviously meant for people who are looking for jobs. But when I retired, I thought maybe it's a good idea to go on the board of directors of some big companies and be a non-executive director, because, nice easy way to get paid a lot of money for doing nothing. I kind of fancy that. So I thought, well, I'm not going to get that type of role unless I do a LinkedIn profile. So I did a LinkedIn profile, and then I saw that people were writing articles on LinkedIn. I thought, well, I can write too. So I wrote a lot of articles. My numbers went from 0 to 10,000 in almost no time at all in terms of followers. And then someone saw an article of mine about the Federal Reserve being insolvent, invited me on their channel. We ended up talking not so much about the Federal Reserve, but about what's called the global currency reset, which was the words I used. He'd never heard those words before. That video went viral. It got 600,000 views for a channel which is normally getting 10,000 views. So I got invited onto a lot of other people's channels. And after a couple of years of being invited, I thought, well, perhaps I should just try it myself and see how it works.
Love that.
So I set up the YouTube channel Clive Thompson about 9 months ago, I'd say, and I've gone to 100,000 views, 100,000 subscribers now.
That's remarkable. Amazing.
So
That's
cool.
so good to see. And I love when diverse perspectives come to YouTube. So I've been making YouTube content for nearly a decade. So I've loved the recent push for like authenticity, different perspectives. And I think that both you and Keith fall into that perspective of not overly done things, just good information and honest perspectives. And so I'm really glad to have you on YouTube and super amped to have you here today. Keith, where do you think we should start with this one?
I think one of the easiest ways to start this off is to just play a quick clip from what Jerome Powell said at the FOMC meeting yesterday.
Yeah,
So
that
let's
made me
roll
laugh. Go ahead.
Always does.
Significant price increases we've seen for precious metals.
Don't take much message macroeconomically. The argument can be made it's without losing credibility or something. It's simply not the case. If you look at where inflation expectations are, our credibility is right where it needs to be. So we look at those things. We don't get spun up over particular asset price changes, although we do monitor them, of course.
What are your initial reactions to that, Clive?
Well, it's the exact opposite words of Alan Greenspan, who looked at gold and said, if the gold price is up, we're in trouble. We've got to do something about it. And if it's down, everything's hunky-dory. He's basically saying, I don't want to put words in his mouth that he didn't actually say, but he might as well have stuck two fingers up at the journalist. How can a guy... How could the head of the Federal Reserve say we don't care about the gold price? I mean, it's sending a signal, isn't it?
Yeah, it's almost hard to take anything that is said in those meetings with any degree of like validity, because it's almost like there's like paradox after paradox. It doesn't really make much sense. But Keith, did you have any other clips that you wanted to show?
I don't know if I have a clip for this one, but there was also a moment where he was being asked about the fall of the dollar and how maybe that might be perceived by the Fed, and he kind of avoided it. He was like, that's the Treasury's job and things like that. What do you think of that, Clive?
Well, look, the Federal Reserve makes dollars. If you get a banknote, it's got obviously it's made by the Federal Reserve or something like that on it. How can he not care about the value of the dollar? It makes no sense at all. I mean, the Federal Reserve's job. I know officially it's to keep inflation down and full employment, but if you are the printer of the country's currency, you've got to care about what it's worth. Not say, I don't care. It doesn't matter. It's irrelevant. It's not our. What did he say? It's not our job. I think he said not our job or something like that. It's the Treasury's job.
Definitely. Yeah, and you've made a video about the potential revaluing of the price of gold, and the price target that you had put in your video, I think, was $15,000. And you had said the two biggest signs would be rapidly rising gold prices and a declining dollar, which are things that I think that we're at least at the beginning of experiencing for sure.
So yeah, I mean, this was a video I did maybe 5 or 6 months ago,
Yes.
where I said at some point we'll know we're potentially getting towards the end game when you start to see asset prices, in particular gold, rising rapidly. And the reason I put a $15,000 price on gold was not because I think we climbed to it, but rather I think there's the price of 15,000 will be engineered, and that's my number. And I know a lot of people want a much higher number, but my number, it'll be engineered by the Treasury, because by revaluing their gold reserves at that kind of level, and doing a bit of financial jiggery-pokery, which I explained in the video, they will be able to effectively repay several $1 trillion of US debt, kicking the can down the road for a couple of years. In other words, allowing the system that we know it to last a little bit longer. And then, of course, in a couple of years, they can do the same trick again. But I won't go into the details of how it works. But basically, if you take the gold, revalue it, you can actually reduce your debt and keep the gold.
And could you explain a little bit for people who would have no idea how that could possibly happen?
Sure, I will do. So the way that would happen, it all dates back to the 1934, when the US Treasury effectively nabbed all the gold which was owned by the Federal Reserve. They passed a law basically saying the Federal Reserve will sell all its gold to the Treasury at $20.67 ounces, $20.67 an ounce, and in exchange, the Federal Reserve will get what's called gold notes, which are not actually redeemable in gold ever. They're redeemable in paper. That's it. And at the face value. Now, the very next day, I think it was, after the Fed had sold their gold to the Treasury, perhaps rather unwillingly, the Treasury decided to revalue gold at $35 an ounce, creating a massive profit for the Treasury at the expense of the Federal Reserve, and much to the annoyance of all the Americans who'd handed in their gold at $20 an ounce, when they could have had $35 if they'd been allowed to hang on to it for another year. So that's sort of the backdrop. So as we stand today, the Federal Reserve has got these gold notes, which I think is about $12 billion at the official price now, $42.22. It might be $13 billion, but it's something like that. Now, and that's the Federal Reserve. The Treasury has got the gold, which would be worth several $1 trillion at 15,000. I haven't got the figure, but let's call it 3 trillion, for example. I think that's roughly the figure. What the Federal Reserve now, what the Treasury now needs to do is redeem those gold notes from the Federal Reserve at face value, give the Federal Reserve their $12 billion back in cash. Then they will sell the gold that they have to the Federal Reserve for $3 trillion. They'll get $3 trillion of cash in hand, but they don't own the gold. And then they'll immediately buy back the gold with new gold notes from the Federal Reserve. So they'll get the gold back, and they'll have issued in exchange those gold notes, which now become the property of the Federal Reserve. Now, the beauty of the gold notes is that they are perpetual. They're never redeemable, and they bear no interest. And they're not part of the national debt. So suddenly the US government's got, the Treasury's got $3 trillion in hand, which you can use to reduce the national debt to some extent. Not a big reduction, it's 10% reduction, not even 10%, but it would help. They've got this, they reduced the national debt, and they've kept their gold, and the only effectively loser, if you like, in the game is the Federal Reserve, who gets a lot of paper, but what does it matter? They had paper before, they got paper afterwards. Oh, where does the money come from to pay for the pay the Treasury for the gold that the Fed bought? They just print it.
Keith,
nothing wrong with that. They've been printing for years. It's never done any harm. Let them carry on printing.
It seems to work, huh?
Yeah, and Clive, you're based in Switzerland, is that correct?
That's correct, yes.
Okay. And did you spend any time in the United States working in finance, or kind of, how did that evolve, or how did you end up working your way into the industry that you're in now, or that you were in?
Well, the closest I ever got to the United States was the Cayman Islands, Grand Cayman, in fact, where my boss had about 25 banks in his drawer. One of the things everyone used to laugh about inside the Cayman Islands, they all used to say the Cayman Islands has got more treasury bonds than any other country in the world, and euro bonds, and there's more banks than there are people in the islands. But of course, what they didn't realize that most of these banks were just nameplates on the door. And what would happen? Big banks from around the world, I'm talking very large, well-known banks, would have a branch in the Cayman Islands, which is basically a nameplate on the door and a file in your drawer. And what would happen once a month, these banks would send to the Cayman Islands the balance sheet for their Cayman Islands subsidiary. So the people in the Cayman Islands did nothing other than shadow accounting of what the balance sheet said. But these banks didn't really, at the time, have any physical staff in the Caymans. So that was the closest I came to the United States.
That's actually an awesome way to hear about that, because the real reason that I wanted to ask that was because I'm trying to think about there's different markets when it comes to gold and silver, right? And right now we're seeing a little bit of dislocation between the different markets. Could you talk a little bit about maybe if you have any experience with the futures market and like how some of that stuff works, and how there's a difference in different markets in the world and also in different types of markets for the metals and like what's happening with that.
Yeah. So let's just start by talking about a standard futures market like COMEX. Um, the way that works for the bullion banks is they can sell gold for a forward date, and in general, it trades in what's called contango. Now, contango means that the futures price in general is higher than the spot price. So by selling gold for, let's say, March this year, they'll get a higher price normally than the price of spot gold. All they have to do is wait until we get to March, and then they buy back the gold at spot and sell at the future again. So they're constantly rolling forward. And as they roll forward, they make an ongoing profit. And the profit is the difference between the futures price, which is higher, and the spot price where they buy it back. So they short the long, and as it gets to maturity, they close their future, buying it back, and sell another future, going another 3 months forward. And they can keep doing that ad infinitum and make an almost, well, it is in normal times a guaranteed profit. Where that would run into difficulty would be if we go into what's called backwardation, which is the opposite of contango. And backwardation is when the spot price that they have to buy back these futures contracts or buy back the when it arrives at maturity is higher than the futures price. Now, at that point, they're starting to make a loss because they're buying something for more than they paid for it, which is obviously going to cause them losses. And that's how a normal futures market. Where we've got to now is a dislocation between the various markets. If you go into a coin shop and try and buy some gold today, they'll be quoting you a much higher price over the gold price than they usually do. And if you try to sell it, they'll be quoting you a much lower price than the usual gold price than they usually do, because the gold dealers literally do not know where the price is going to be tomorrow. It might be up 5%, it might be up 10%, it might be down 10%, and they have to protect themselves. So we've already got this dislocation going on between the physical market on the street. I mean, if I want to go and buy gold, I'm not going to get it for the 5,000 something that you see on the screen today. I'm going to have to pay a lot more than that. Now, silver has gone into a much more extreme situation where we've got the price of silver in Shanghai trading at an absolutely massive premium over the price in COMEX. And the reason for that seems to be that the usual shipping of silver to China from America to China when there's a dislocation in the price isn't happening. Now, we don't know the reason it's not happening. Maybe the usual bullion banks who would do that arbitrage can't lay their hands on the silver in New York for some reason, or maybe the shipping companies which would ship it are all booked up. So I don't know the reason, but we have now effectively 3 prices or 4 prices in the world: the dealer prices when they buy, dealer prices when they sell, the COMEX price, and then the Shanghai price. It's all over the place.
Thank you for explaining that. Someone asked in the chat too, they said, ask Clive about how does shorting work? And, we've seen a lot of rumors about potentially banks shorting silver and gold. And then there was a rumor that some big bank like blew up and then the Fed tried to save them in the United States. Did you hear anything about that? And then could you briefly explain a little bit of how shorting works?
Yes. So the story about a big bank blowing up was a lie by an artificial intelligence robot who was producing videos for the purpose of views. If you read the small print under that video, and very small print and hidden away where nobody would see it, you would have discovered that they do say this is fiction. But they told the story as if it was fact. And unfortunately, many people who don't know how to read repeated the story as if it was fact, because they think that everything they hear what was just unbelievable, that you've got a robot saying, I've been following the price of gold for 25 years or something like that. No, a robot. This is like an AI robot says he's been following for 25 years. It just makes no sense. And so everything in that story about a big bank blowing up was complete rubbish. But the worst part of it was I saw at least one newspaper grab that story and print it as it was a Swiss newspaper, funnily enough, printed as if it was fact. And they did say, in the small print, these are allegations, but
Yeah, the damage is done.
yeah, I mean, that was really bad. So what is shorting? And so this bank is not short. I mean, maybe they've got a little bit of short, but they manage their risks very well. I won't say the name of the bank because I don't want to throw any petrol on the fire. But when a bank goes short, they're basically doing what I say. They are selling the future contract, expecting to make a profit by the time it reaches maturity because the price goes down. The future price is generally higher than the spot price. And it's a kind of way of making free money until you have to buy it back for more than you sold it for, and then you've got a problem. Now, generally, to protect themselves, they keep gold or silver somewhere. But that gold or silver might not be in the right shape or form for good delivery. So from a financial point of view, they're probably, if they're going short here, they're short here, they're long over here, but it might not be possible to deliver this one into that one because you've got it in COMEX, you've got to have a certain size bar, it's got to be registered, it's got to be, a lot of things got to be just right, it's got to be exactly the right shape and size. So if their gold is not in the right place or not in the right shape, in normal times, the option would be to move one asset into the other. But if the markets are in a disrupted state, it might not be possible to do that because you might find the smelters can't change the size of your bar to an acceptable size bar. And therefore, you're stuck with a panic situation where you can't, as you haven't got anything which is allowed to be delivered, even though you've got the same thing, but it's the wrong weight. You have to now buy at market, irrespective of the price, to cover your short.
Fascinating.
Totally. And, I feel like people want to believe that story, right? They want to hear that there's some big bank in the markets manipulating prices and keeping them from getting rich, quite frankly. And there have been some times in the past where there was an official story. I believe it was the Hunt brothers in the 80s or something like that. Are you familiar with that story at all? And does that...
Sure. Yeah, I've read the book. I've read the book Silver Bulls, which was about the Hunt brothers and how they got screwed over by COMEX and the authorities. But the gist of it was they were trying to corner the market. When you corner the market, you try to buy up everything in the market so that those who want it can't get it, and therefore those who want it have to pay through the nose to get it. So they were trying to buy up all the silver, and to do that, they took on. They were buying a lot of physical silver, but they also were buying futures contracts on COMEX. The trouble was the shorts, and at the time silver ran from about $1 to $50. So we're talking about 50 times. So if you imagine someone was short at $1 or $2, and now they're having to buy it back at $50, they were in extreme loss positions. And all these big exchanges, they love the shorts, but the shorts are what makes the market. I mean, having someone go and buy silver, they've got to have someone to buy it from, and the only place you can buy it from is someone who's shorting it, selling it. So the shorts make the liquidity in the market. So the exchanges love the shorts. So when things go wrong, they're more likely to protect the shorts than they are the longs. And that's exactly what happened in the Hunt brothers. They changed the rules. I think they brought in something called Silver Rule number 7. But the gist of the changes in rules were, one, the Hunts were prevented from using borrowed money to buy more silver. And secondly, the number of contracts which they were allowed to own when they rolled their positions was limited to a certain number of contracts. So let's say previously that you could buy an unlimited number of contracts. Now they said, sorry, you can't buy more than 100 or 1,000 contracts or whatever it was. So suddenly the Hunts found themselves with, let's say they had 5,000 contracts maturing, but they only had to buy 1,000 on the next series. They had no other choice than to liquidate their contracts at any price, because they weren't allowed to turn it into real silver, because that would have meant borrowing money, and they couldn't roll it to the next future date, which was the original plan, because that wasn't allowed by the rules of COMEX. So basically they were screwed over and were forced to sell, which crashed the price of silver, and effectively ended up making them bankrupt.
Totally. Ben, did you have something?
Yeah, there's a question from the chat because with all of this discussion, there's more and more people that are interested in buying precious metals like gold and then also silver and then copper. I'm hearing questions about as well in the chat. As an individual, where do you recommend buying metals? Like, where should an individual go to buy gold? Is there a right way? Is there a wrong way?
Well, if let's start with silver, because I think there's a bit of an opportunity for those who want to get silver at the moment. There are many precious metal dealers who have been overwhelmed with sell orders, and the refineries are backed up, so they're not in a position to lay off their risk with the refineries by passing on the silver they bought to the refineries. So that literally, when people are walking in the shop now, they're saying, "We'll give you. You want to sell some silver? We'll give you $20 below." Massive. So the opportunity here is to ring around and see if they'll let you take some of that off their hands at maybe $6 below the silver price or $10 below the silver price. I think in many cases, they'd be very, very happy to get rid of it so they can accommodate all the people who are coming in the door, because they've only got so much money. If you've only got $1 million, once you've bought $1 million of silver, unless you can pass that on to the refinery, you're stuck. You can't buy any more. You've got no money. So to make money, you've got to unload some of that silver. The only way they can unload it is by selling it below spot. So I think if you try your luck on silver, you could ring round some silver shops and see if any of them will sell you at a decent discount. And I'll bet you the answer is yes. I mean, I've heard some of them say yes, so I'll bet you the answer is yes. And you might be able to pick it up below spot at the moment. But by the same token, there'll be many silver dealers who will want to charge you $20 more than spot because they've got their inventories going the other way and they're running out of it. It just depends on the country, the town, the village, the sentiment. Things are all over the place at the moment. On gold, I think it's going to be a lot closer to the gold price, whether you're a buyer or a seller, because there doesn't seem to be any particular problem in the gold market at the moment, other than everybody has suddenly decided, and for good reason, that they better get some while they still can get some. I think what's going on with the gold market now is it's a different kettle of fish from the silver market, but what's going on is up until a couple of years ago, people kind of saw gold as a steady as you go and inflation hedge asset. If I want to hedge myself against inflation, I can buy some gold. It won't pay me any dividends, it won't pay me any interest, but probably in 10 years' time, it will still buy me what I the same as I paid for it now. That's how it was viewed. But that attitude is changing now, because people can see that things are going potentially wrong with the levels of government debt and geopolitics. And they're starting to say, I don't know what's coming, but I think I don't really care about inflation anymore. I'm not looking at inflation and gold. I think I'll get some gold now because I don't know what's coming, and that I'm going to front run what might happen next week, next month, next year. And I'd rather be ahead of the curve and get it while I still can, and get it before everybody else. Because the minute everybody else realizes what I've realized, that's what they're thinking. They've realized that this government debt is unsustainable. Something's going to happen. And they say, well, the rest of the world hasn't woken up to it, but I've woken up to it. I better get my gold while I still can, before everybody else wakes up, because it's going to be a lot higher. So that's basically, I think, what's happening. People are front running it. It's not just individuals. It will be central banks as well. Although it's very hard to get the evidence for that, because the statistics and the reporting by central banks is very long delayed by the central banks themselves. And there's lots of central banks who don't report at all.
Quick note on that, I'll share a tweet that I saw from the Kobeissi letter, I believe it was earlier today. Breaking: gold has officially overtaken US Treasuries in central bank FX reserves for the first time in at least 20 years. So essentially the global gold holdings are at 5 trillion, surpassing the foreign official treasury holdings of 3.9 trillion, with gold holdings have tripled since Q4 2019. So even with any potential delays, right, that we may be seeing in how central banks are acquiring and whatnot with gold, one thing for sure that we can see is that, well, the amount of gold that they're holding versus FX reserves is obviously going up versus US Treasuries in their FX reserves. And then also in general, we've seen a huge uptick in the amount of central bank buying, right? Buying even over the past year, where prices have almost doubled before even all of the super crazy mania that we're just now starting to step into. So I just wanted to point that out a bit. Any initial
Yes.
thoughts on that?
Yeah. Well, um, the the Chinese central bank is in there every month buying a little bit of gold. I mean, I won't say it's huge amounts, but they're a steady buyer. They don't care about the price. The gold in the Chinese central bank reserves, foreign exchange reserves, is rising as a percentage of their overall holdings, partly because they're buying more and partly because the price is going up. So what they're doing is, I think it's, I haven't got the figures in front of me, but a year or two ago, I think it was like 3% of the reserves. And I think it's probably about 6% now. That's not a precise figure, but it's certainly a lot more when I last looked. So I think what's going on with the Chinese, they're allowing the generalized rise in the gold price plus their purchases to constitute a larger percentage of their reserves, whilst at the same time not making a great deal of effort to increase their holdings of treasuries.
Fair enough. Fair enough. And then one of the things that people are thinking about as far as how to get involved in all of this is uh, paper versus the actual physical metals. That's a huge question that I've been seeing coming up. And can you describe like the difference between like paper, having metals on paper versus having it physically, and how you look at that as an investor?
Well, first of all, a lot of the people I talk to have got sufficiently large amounts of money that they couldn't possibly keep the metal at home or shouldn't keep it at home. We're talking about many millions in many cases. So you own, for your parachute, for your emergency money, your lifeboat, you only need a certain amount where you can get your hands on it quickly and easily. That could be in your home, buried in your garden, or a very safe location somewhere where you can get to quickly. For the rest, you need it locked up. If it's physical, you need it locked up in a very safe place underground in a strong, a very strong vaulted bank. But that type of gold is the type of gold you should never be planning to sell. You should be planning to keep it forever, pass it down the generations, just like a painting or a work of art or the family castle. Those are the things. The gold physical is what you don't sell. You hang on to forever. If you plan to sell it, you shouldn't be buying physical, because if you have a plan, I'm buying it today and it'll be higher tomorrow, I'm going to sell it tomorrow, then you want to be buying the paper. Of course, you're not. It's not real gold. Okay, it's not a parachute. It's not a lifeboat. It won't save. If there's a panic, it won't save you, because you might have all kinds of difficulty. But all these exchange traded funds have what's called force majeure clauses, under which, if it's not their fault, for whatever reason, they don't have to give you the gold back. So, you can imagine in certain types of situations, and those situations, by the way, are outlined in the prospectuses of all these ETFs. I know there's all kinds of things, like war, civil unrest, transport difficulties, supply chains, taxes, government decree. There's everything under the sun you could possibly think of as an excuse why they might not give it back to you. And of course, you can only get it back if you have a certain amount, like $1 million or whatever the cutoff point is, because you can change your shares for physical metal if you qualify in certain ways, and most people wouldn't qualify, so that's not really an issue. But if you're thinking of buying today and selling next week or next month or next year, then the paper is the way to go, because when you're buying paper, there's a very narrow spread between the bid and ask. It's like 0.25% or 0.1%. You pay a very small commission to the bank or broker when you buy it and sell it. And of course, it's nice and convenient, because with a flick of a button on your mouse, you can sell it in a microsecond. Whereas trying to sell physical coins, you'd have to walk to the dealer somewhere, and then he's going to screw you over on the bid and ask price when you do that. But if you're buying physical, you shouldn't care about the price. You should say, it doesn't matter if you pay 20 or 30% more than the price. That's irrelevant. That's not, that's neither here nor there. What you're buying is you're buying yourself a lifeboat. You're buying yourself some insurance. You're buying yourself some protection if everything else starts to go wrong. I mean, if you look at the Weimar inflation in Germany, then gold, things like negotiable things like gold became relatively far more valuable than things which were hard to negotiate, like houses. So it got to the point where you could buy a house for just a couple of gold coins because people couldn't use their house to eat, but if they had gold coins, then they could negotiate those into other stuff to eat.
Very well said.
So in a disaster situation, you wouldn't really care whether you'd overpaid, underpaid. You don't care. It doesn't matter.
Mm-hmm.
You just have to have it. It's like having your health insurance. When you need it, you're really glad you had it, and it doesn't matter that it was expensive or not. You've got it, thank God, as opposed to having none.
So one of the things that you kind of pointed out, I think, requires kind of everything hyperinflation. You mentioned. One of the things that I think is so fascinating about what's happening right now regarding the US dollar is that not only are gold and silver going up, but all precious metals are going up. Can you talk a little bit about the dynamics of that, or why is it that all of these different metals are almost at all-time highs now?
Well, obviously, gold, silver, platinum, palladium are regarded as the precious metals, and an outside runner perhaps is rhodium too, but I don't think anyone in their right mind would buy rhodium. I think the price, I know the price is probably $50,000 an ounce. I have no idea. So rhodium, you wouldn't be able to find it if you wanted to. So what happens when you've got one precious metal rising? People say, well, perhaps I should own them all. Now, most people don't. Most people say, I'll stick with gold. Then a much smaller number say, well, I'll have a bit of silver as well. And then even smaller number say, I'll have some platinum. And even tiny amount, people say, I'll have palladium. But the fact is, the silver market is a tiny fraction of the gold market, about 1/10 of the size. And the platinum market is about 1/10 of the size of the silver market. So it's getting really, really tiny. So the platinum market is 1/100th of the size of gold. And a very, very tiny amount of buying will have an upwards effect on the price. So even though almost nobody's buying platinum, there's still one or two people who are buying it, and that's pushing up the price. But we have to remember that silver and platinum have a dual use. Unlike gold, silver and platinum have a dual use in industrial demand. I mean, the platinum is used in catalytic converters in cars, and silver is used in electronics, solar panels, defense, and what was the fourth one? It's gone. What are they use silver for? But electronics, defense. No, I don't know. But there's a fourth use of silver, which is using up a lot.
Understood. There's an investor out there. His name is Chamath Palihapitiya. He does a podcast called All In. And at the beginning of the year, he made a prediction that he thinks that copper will be the biggest winner of this year. I'll share a quick screenshot of a tweet that he put out. As we predicted in our annual predictions episode to start the year, unless someone shows up with superconductivity or carbon nanotubes, copper is the only game in town, and AI is a huge demand driver for a very under-resourced material. Mm-hmm. What are your thoughts on copper and what that could look like in the future?
I've got my little boy poking his head in the door there. Okay, so copper, I'm positive on copper. I'm not sure we're going to see the sort of spectacular gains we've seen in gold and silver, but I do think it should go higher over the years which follow. And the reason for that is we have ongoing rollouts of cables, data centers, and that sort of thing. And from what I read, that those kinds of things are going to be consuming incremental copper over and above the standard use of copper, which is always there when you're building roads or railways or whatever else. So it's effectively a new use of copper, and I understand it to be quite large, and therefore the demand for copper should rise. And the price of copper should rise too, but I don't really see the kind of squeeze we're seeing in silver and gold at the moment. I think it's probably, in terms of tons, it's probably a bigger market. Well, it definitely is a bigger market, big time. And there are some copper mountains coming on stream, like in Argentina, in the next couple of years anyway. So the supply probably will go up. So the way I would play this is not really to go buy copper bars. I mean, you need an awful lot of space to store copper bars. You would want to buy the mining companies. There's a number of pure plays and a number of large mining companies which do multiple things.
But Clive, I wanted to move into what does someone really kind of do about all of these things that are happening right now. I saw this earlier today. It said if you measure the S&P in gold instead of dollars, the U.S. stock market has basically collapsed right now. So for the individual that's watching all of this and they're seeing the price of gold at these astronomical highs, all-time highs, same thing for silver, how do you even get involved with any of that? And in general, where should people be looking to position themselves right now?
Well, first of all, nobody should be doing anything in a big rush. So whatever they decide to do, they should move slowly and then see how they feel. It's all too easy to get excited about a particular asset and then put more than you should have done. You don't realize that at the time because you're greedy and you think this is definitely going to be a winner, and you put far more than you really should be by any sane. If you were talking to a proper advisor, you put far more than sensible, and then guess what? Often, well, I won't say often, but sometimes it doesn't work out, and you regret what you did. So my first advice is whatever you decide to do, whether it be equities or Bitcoin or gold or silver or property or anything else, go in gently in small quantities, take a breather, see how you feel. If it doesn't bug you that the price is moving around, buy a bit more. And it doesn't matter if you're buying at a higher price than you paid or a lower price you paid, because either way, whether you're buying at a higher or lower price than previously, you're guaranteeing yourself that you're not the last fool, because the last fool is the one who paid the highest price ever. But if you bought on more than one occasion, you've got two prices, so your average price cannot be the highest price, and therefore you're guaranteed not to be the last fool. So that would be my first bit of advice. If you don't have any precious metals where you can get your hands on them quickly and easily, I think it's time to start. Go and see what you can buy. Don't care about the price for a little bit because you're buying so little. You shouldn't be caring. If you're buying, let's say, for 1% of your assets or 0.5% of your assets, does it matter that you paid 5 or 10% too much? It doesn't. It doesn't. You're now in the game, and you're able to increase that later. And if prices settle down at a lower level, great. You can buy some more at a lower level. And if they go higher, great. You were a smart one because you were an early bird.
Yeah, I think making the decision, the I am statement, that I am an investor, it takes the conviction to actually start is a big thing. And I think that's great perspective, especially in an era when everyone is operating on fear 24/7. Dipping your toes in, dollar cost averaging into whatever you decide is the first thing you want to touch is fantastic advice.
One of the things which has worked very well for me I've been buying gold all my life, so it doesn't really matter. But if I talk about equities, when I go into a particular equity, I have a 33% rule. It's on my website, Clive Thompson. It explains how it works. But in simple terms, when you decide to buy a stock, you think about how much you want to own at the end of the day, divide it by 3, and you invest 33% of that end amount in the equity. Then you wait. And you can wait a day, a week, a month, a year, or years. Doesn't matter. You just wait as long as you feel like waiting. And after a few days, the price will be higher or lower. And you can see how you feel about that. And then you can decide whether to wait longer or not. But the good news is, if the price starts accelerating away from you, you might never need to buy those other 2/3, because in 2 years' time, you might have got your full position without having to spend 2/3 of the money, which gives you spare money to buy 2 other things. And if the share price goes down, you can ask yourself, how could I have made a wrong decision? you better go and look and find out what went wrong with your decision making. Were you really, was there something that you didn't see that you should have seen? Because obviously everybody else is seeing it. They're selling the shares. Why? It's a lesson. If it's going up, there's another lesson. I probably got it right because everyone else agrees with me. But if it's going down, that's when you've really got to figure out, is everybody wrong, or am I the one who got it wrong? Because other people push the price down by selling before you. And you have to find that out. If really everyone else has got it wrong, you're the only guy who's right, well, great, you can buy your next 1/3, except you get more shares for your next 1/3 than you got for the last 1/3. But on the other hand, if you discover what you hadn't discovered before and it's gone down, then you can say, you know what, I can sell it. I only bought 1/3, the loss is so small, it doesn't matter. Whereas if you bought a full position, it kind of hurts to take the loss.
Love it. So you've spent an entire career, from what I understand, in finance and even investing for yourself. How important would you say is managing psychology and your emotions in the game of investing?
Though, well, I'd like to tell you that those who can master their psychology are the winners. Um, I don't know that that's necessarily proven, because we've seen, all these countless hedge funds come and then shut shop. So we've got a certain survivorship bias here. These hedge funds are the guys who are telling you, I have a track record of seeing the future and controlling, and a disciplined approach and control the future. And then I know this because I've been investing in not me personally, well, a little bit. I've had clients investing in hedge funds all my career, from the late 1990s when they started to exist. But let's go back in time. Some of the biggest geniuses in the world won the Nobel Prize for, I don't know, mathematics or economics. The guys who ran long-term capital management. They nearly took the whole world under. I think it was 1999 or 89. I can't remember now. When the biggest hedge fund in the world collapsed, having to be bailed out by the Federal Reserve to save the banks. Now, these were people who had worked out the perfect discipline where nothing could go wrong with the way their system worked, except something went wrong. We don't know what it was. So discipline, I'm not sure that discipline is. I think the real problem is panic. What you do not want to be is somebody who's panicking every time the price goes in the wrong direction for you. If you buy something and the next day it's down, you say, "Oh my God, I'm not going to look and find out what I did wrong. I'm just going to get out of it because I can't stand this panic. I'm not sleeping at night." Then you're in the situation where you're going to incur a lot of frictional costs as you go in and out, driven by every bit of news. One of the things I tend to do, and to avoid that, because I'm not going to pretend I'm a disciplined investor. I'm going to pretend I'm going to say that I do something differently. When I buy, and I'm talking about stocks here, when I buy a stock, I tend to put it away and forget about it for a year. At least, I'm going to put it another way, I don't watch the day-to-day news. I'm not sitting there looking at my portfolio saying, that was gone up, why did it go up? That went down, why did it go down? I'm not checking. It would be quite tedious to check, because if I was checking, then I might see a bit of bad news and think, oh, I better sell before everybody else. Except you're never selling before everybody else. And then I see a bit of good news on another one. I think, oh, buy that one. And that starts to create trading. I'm not a trader. And if you trade, the more you trade, the more you're incurring frictional costs, and the harder it becomes to make money.
Very well said. Very well said. For the people that are watching who uh, want to find ways to become a better investor, a better thinker in general, are there any books that you've read that you recommend to anyone?
Well, if you've got the guts for it, get Ben Graham's The Intelligent Investor. It's a very thick tome. You see, you're looking behind yourself. You got it
Yeah, I've got
on
it
your
somewhere.
shelf, Ben.
Yeah. Yes,
Yeah.
yes, sir.
But I think most people, if they want to get started, can buy a book which would have a name like Beginner's Guide to Investment. Don't buy any of these books which say "Get Rich in Stocks." That's That's the Ben Graham's intelligence. So the books which say get rich in stocks, they usually have some magical system which they claim works. And, the systems there's nothing wrong with the system. They're all valid, but they're not valid all of the time. They work some of the time, and some of the time they don't. So when you buy one of these books which says get rich quick, you're going to find in that book there's going to be a magic formula, like buy companies with low peg ratios, or buy companies with high momentum, or buy value companies, or buy companies where the board of directors are buying the shares. And these are all magic formulas, and there's plenty of them. What I would do is buy a beginner's guide to investment where they cover the basics, and then you can start to look at the kinds of things you should be looking at, like, is the company making a profit? Do they have a product that people are likely to need the same of or more of in the future? And are they turning that profit into positive cash flow? Because don't forget, profit isn't necessarily cash in the bank. You could buy a ton of steel, and then the price of steel goes up, and you can say you've made a profit. But if you haven't sold it, you can't pay the staff.
Completely.
So that actually also just perfectly led me into something I meant to ask earlier. In one of your videos, you actually brought up the fact that Rick Rule, who is a very popular precious metals investor, has been selling his silver position and rotating into silver miners. And he actually quoted something very similar to what you just said there in making this decision. He was like, paper money's paper money. It's not real. The gains are not yours until you realize them. Um, you touched a little bit on this before, but I wanted to really pick your brain on looking at the miners versus the spot opportunity, or trying to buy physical precious metals of some sort. What do you think about that?
Well, I've spent the last few days in my very small amount of spare time, because I'm quite overwhelmed with questions, but I spent the last few days studying gold and silver miners to see where the price ought to be if the price of gold and silver stands still at the moment. I've probably got through no more than 8 to 10 stocks, so it's quite a small sample at this point in time. And my conclusion is that on average, they ought to be about 145% higher than the current price. And that's based on some very, very complicated mathematics. I'm looking at lots of different things where, how much they were producing 12 months ago for the quarter, 12 months ago, how much they're producing for the quarter now, what the price was at the beginning of the quarter of their metal, what it was at the end of the quarter, then what it's now, then what the price was on the day they announced the results, how the share price behaved throughout that period, and how the sales changed with the gold price or silver price, and how the costs changed with the gold and silver price. So it's quite complicated calculation, but at the end of the day, I get to some numbers which tell me that a small number, one or two, might be overpriced at the moment, but across the board, they're very underpriced, and very, very underpriced. I think if the gold and silver prices hold where they are now, we might be looking at share prices of 140% higher in a year and a half, when the impact of these higher earnings comes through. And Rick Rule's got it right. I mean, the important thing to say about him, he is a person who has donkey's years of experience in that sector. He also has a great brain which can work out, just as I am doing, what the future profits will be of various companies. And he's even doing something which I cannot do, which is assessing the value of companies which are not yet producing, but which might produce in the future. Now, that's mathematics I won't even attempt, because I think it's too difficult for me to say what a company might produce. There's too many unknowns. But at least with the producing companies, you've got a fairly good idea. You know how many ounces of gold they produced last year. You know how many they produced this year. You know how many they think they'll produce next year. You can put a price on each of those productions. You can see what their costs were last year, what they are this year, what they which direction of travel they got for the costs. Put a decent estimate on the costs, and you can come out with a gross profit, and then you can knock off some other expenses, like how much they spend on prospecting, marketing, management, and non-mining costs, and you can get to where the bottom line might lie in terms of earnings per share. And then all you have to do is put, now another complicated thing, what multiple do you put on it? I tend to put, to reach my conclusion, I tend to put a low multiple, but if you are in a period of rapidly rising earnings per share, it's more common for high multiples to apply to companies with fast rising earnings per share. But putting a low multiple, I get to much higher share prices than today across the board. So for someone who doesn't know which ones to buy, you could probably just buy an exchange traded fund and you get all of them and you'll do fine.
Amazing. So where do people go to source information to make an investment thesis? Because if you just scroll, let's say a platform like Twitter, where I think a lot of people use that for their investment information, which is definitely a dangerous game. I don't recommend doing that. But where do people go to get like solid information that they can actually use to make decent decisions?
Well, the absolutely amazing thing we've got today is there are countless tools out there, investment tools, available to the man in the street, which give you far more information than ever before in history, and which are very, very hot competition for those expensive tools which you find in financial offices like Reuters and Bloomberg. Those are very expensive tools. But we as private individuals can get almost all of the information we want by paying $20 a month, for example, from lots and lots of different tools. If people would like to look at my channel, clivethompson.com, the very last video I did explained the use of a particular tool, shows how to use it and shows the value of that. But there are other videos there, and you can find out what works for me and what works for other people. But yeah, you got to, in a way, you've got to. And by the way, the tool I'm using is a free tool, free of charge. So it's not like it's going to cost anybody to do that.
That's amazing.
So all you have to do is look around, find a tool which works for you. There's different, some people want very, they're very good with numbers. They like to look at jumbles of numbers and pages and spreadsheets, and other people just want to look at a green blob, and if it's green they buy it, and if it's yellow they don't. It's kind of depends on what people are happy with. Are they more picture people, or do they want to read the words? So there's websites which translate these fundamentals into words. There's websites which present the fundamentals in hard numbers, and there's websites which put it into a picture type format. So all you have to do is pick what suits you and go for it.
Wait, what you just finished watching was only part one of this highlight from our live show Memes and Markets, where we go live every Tuesday and Thursday at 12 p.m. Eastern. But this conversation gets even better. Hit that like button and subscribe and click here to watch the second part of this highlight.